Record. Speaking someone. All right. Hey, welcome everybody. Let's get going. Begin. 8/1, August 1st. New month, new me. New month, new Bracco. It is we have what? August, September, October, November, December. 5 months left of the year. This is season 13, episode 9 of Sharpen Your Trading Skills. We titled this Fireside Chat with Bracco and Patrick. We're kind of just gonna go through and I think dissect not only I think some waves in sentiment that Bracco and I've both seen in the chat, but have experienced as well in terms of ups and downs in market sentiment, how as well as how we have tried to, or how we have executed handling those waves in sentiment and price, as well as trying to preach and teach some skills to sharpen your trading for when, if the market stays this way, if it turns, or for the next period like this. What do you think about that agenda, Bracco?
I think that's a great agenda. That's exactly what I'd like to talk about today. I'm not gonna lie, I've seen a couple traders blow up already in the last 2 weeks from this market. And it's pretty simple, really, right? What happens is you get so complacent in a specific environment, right? And then when that environment shifts, one of the most important things you can do and learn as a trader is to recognize that environment shifting. And I feel like we try to really spend a lot of time emphasizing that, even if we're wrong, right? We're always trying to look at the other side and try to, pick the red flags out of the market, just to, keep that in the back of our head. Even though the market's in a downtrend right now, you're still looking for, stocks that look like they're, showing relative strength and that are ready to go, because at any moment this market could bottom, and the same goes in the other direction, right? And I think it's a very important skill to know when things start to shift a little bit, and to learn to kind of adapt your style to that. If you're if you're pretty skilled to the short side and you know how to trade shorts responsibly, this has been an awesome couple of weeks. But if you don't, I hate to say this again, because we say it every single day in this kind of market, but if the 9 EMA gets below the 20 EMA, get in cash and just sit on the fucking sidelines. Seriously. That is probably the best thing you could do, especially if you're not experienced to the short side. Anytime, the markets entered a correction and the 9 got back above the 20, we got back above the 50-day, there was so much time to recognize the environment shifting and get long on stocks. Each correction has led to a 2-3 month uptrend following that. So you don't need to worry about picking these bottoms and getting fancy and trying to time the market, right? You will probably, if you're not experienced to the short side, save yourself so much money and mental capital just sitting out when the market is in a correction and just studying. There's this one trader on Twitter. I highly recommend following them. Their name used to be Miss Low Risk, but it's Mr. Low Risk, and I'll link the Twitter in the chat. And I don't know if it's a he or her or not. I'm not sure. But they trade based off Komagi's teachings. Pretty much everything he's ever taught, that's how this person trades. And anytime the market is below the 9 to 20, they don't trade at all. and you can see them journal and post every day on the days that the market is in a correction and the nine's below the 20. They're rewatching Komagi videos. They're studying traders. They're going back and studying previous markets and previous leaders, annotating charts, reviewing trades. That's what they do on those days. And then when the market finally, comes out of that correction and the nine gets back over the 20 and there's bases and new setups, they're ready to just pound the table and get aggressive on the market. And I think
So
that's
sorry to interrupt. So here's my question. Because we've said that. I was just going back and looking through the morning here on 7/24, right at market open, saying we're below a declining 9 and 20. There's nothing to do here until that changes. Don't be a hero. We can go back and look at P&L from either ourselves or from other traders, and see what their P&L is from starting Wednesday the 24th through now, and I'll bet 95% of people have lost money. Even though, right, whether even though there's been, great short side alerts from Bracco from Yeti, I'll bet 95% of people lost money. So I guess my question to you, Bracco, is actually, this is what I want to say. Where I've had a little bit of challenge. So, right, I accepted that the QQQ and the S&P were below the 9 and 20 May, and I don't really want to touch those or the related stocks within them, right? Your XLK stocks and your SMH stocks, right? Where I've gotten into a little bit of trouble and I've had, a few losses on, right, ONON, Instacart, or XBI as well, ARC. What about strong relative strength sectors that are above those MAs? And, maybe discussing what the approach is dealing with those relative strength sectors. For example, XBI, this chart still looks, really nice. It's a, inside day, this could break out tomorrow, and it's one of the best stocks, looking stocks in the market. 3-day pullback into the 9 and 20, remounted yesterday, broke over previous day's high, right? This has, everything that I like to see. 65-minute, got that go signal right here where we swept below and started pushing. Is, how do we distinguish between holding back on entering breakouts in relative strength versus avoiding completely?
a great question. And I think you'd be better to answer that because you have been trying stuff lately where I more so have not really been doing that.
That you've been shorting the relative weakness.
Yeah, I mean, some of the relative, it really goes back to a lot of the teachings that you taught in 2022. I had to learn to trade. I essentially had to learn to trade to the short side. So it's kind of like engraved in me, right? Like that's where I started. And the first thing I think of when the market starts to break down is range, liquidity, familiarity. I mean, those are the three things you taught. And a lot of the stocks that have been showing relative strength of the sectors, I personally don't trade often. And I think my mind and my money is just better focused on like trading tech to the short side. I like to think, I like trading the short side better. Maybe when it comes to like day trading, just because I think my ideas play out a lot quicker and I like that. It's a lot smoother. I know it's more volatile, but I like that volatility. But yeah, I don't know. It's hard to say. I really like trading.
Line, man, I've just put can slim. M is market. And that's kind of what we're experiencing a little bit in, even some relative strength sectors. XOM, there's a nice trade here, right? Pullback to the 9, had a couple days of follow through. And it's back down here, right? This trade has gone, nowhere right now. Or even some healthcare relative strength like this Johnson & Johnson looks fine. Am I going to look to take a red to green on this tomorrow? Well, actually, yeah, it is on my watch list tomorrow. I'll take a red degree.
I mean, just look at the Dow, though. This looked phenomenal up until today. And as soon as the broad market gets hit really hard, this comes down with it.
Yeah, breakouts are just more likely to fail. So instead of going from, think about it like blackjack essentially. When the market gets below the 9 and the 20, it's like the dealer has an extra face card in their deck or extra probability. So the odds shift from 50.1% to 51% in their favor. And that extra 1% odds for the market versus for the trader, can result in losing a significant portion of your stack, and not allowing you to make a new bet when that face card gets played out, and it's back to reasonable, predictable odds again.
That's a good way to put it.
Um, so there's been publicly, since Zoom, right, there's since we started live trading on Zoom every day, there's been the bear market with all the bear market rallies and the big downturns. There have been the sideways bottoming action and then the big breakout bull market, and then there's been about 2 to 3 big or notable corrections in the market since. One of them back in October or whatever, July to October of 2023, I was really focused on shorting a lot of them, or at least the previous 3. I was really focused on taking some breakdowns of some of those stocks, right? That these were failing, these were coming back through the 50-day moving average and rejecting. It kind of ignoring that the weekly chart was, just, setting up again for a massive cup and handle breakout. And then I was, a couple days late to the breakout occurring, had a few positions in Robinhood and Affirm and a few things, but that was really closer to mid-November rather than the early part of November. And ended up missing out on a few things that just went super quickly and worked really well. And for the drawdowns that I've gone since, I'm like, okay, well, I'm just going to wait. Once we get under these moving average, I'm just going to wait until we remount and the market is playable again, and capitalize there, because it was so easy to ride stocks for days, weeks, months even, when the market was trending higher, and it took like a couple, 2, 3, 4 weeks to adapt back into that easy market after we just completed adapting to the changing environment. So as a trader, you don't have to adapt to the environment. You just have to adapt to your system and turn it on and turn it off.
Exactly.
And
Yeah.
Kind of goes back to a Swiss Army knife, or just a beautiful long katana blade, right? You know, which one are you going to want to wield? um Anyways.
Yeah, I mean, I mean, I'll be completely transparent here. I had a red month in April of this year. I had a drawdown in April, and it started in the second half of March. And I also had a drawdown in September. The September one was my worst one in like the last year. And then October, I also had another red month. And I think a lot of it was me being stubborn and what you just mentioned about not turning my system off. I wasn't willing to, I wasn't willing to really, I don't want to say adapt, because I know you just said you don't have to adapt, but like I wasn't willing to adapt. I wasn't willing to change. It was like definitely like a stubborn feeling, like the market's wrong, not me, that type of shit. And that's a toxic mentality. And I knew we were getting close to another correction. I had a feeling as soon as that day happened on CPI, that was like, I feel like the first warning shot from the market. And I kept telling myself that as soon as we start to get this next correction, like I'm not making the same mistakes. And I completely, shifted everything for the most part. Since then, I've only taken 3 longs on tech related stocks. 3 longs. And that was when I tried to play D-Dog, PanW, and what was the other one I tried? ZS. And those looked great. And as soon as those failed, that was a sign to me that I need to kind of stay away from long in this sector for a little bit, and maybe even start focusing on the short side a little bit. But I can't lie, I had those red months, I had those drawdowns and those corrections. And since July 11th, since the QQQ topped on CPI day, my trading account's up 72%. In that time period. And believe it or not, in that time period has been the least trading I've done. They've just been really good trades, really, really good trades. And obviously TLT was a awesome, pretty big part of that. That was, in my opinion, pretty uncorrelated to equities. That was kind of telling a different story. So I didn't mind taking that long. I thought that was a phenomenal setup that we played on that. But yeah, I mean, I tried a few scalps on QQQ to the long side that were pretty small, but other than that, I mean, I was just really focused on not longing tech and semis. They were clearly given, big red flags. We had the long on IWM. That was awesome. That kind of, contributed to that, 72% run as well. But I think a lot of people want to be early to catch in a lot of these stocks on the bottom. Just look at Minervini. QQQ had its best day of the year yesterday, and he posted on Twitter saying that this was most likely a dead cat bounce. Isn't that crazy? Best day of the year. And he says that we don't trust it. The market needs to prove itself, right? I mean, we were still below the 50-day. We were still below the declining 20 EMA. He doesn't care to be early, right? He wants to wait till it's the perfect time. He wants to wait till everything is looking healthy again, right? And I think a lot of people are trying to rush that process a little too quickly. And I think part of that comes from how hard this market has ripped out of corrections. And maybe a lot of people like fearing that if this market does take off, they got to be in. You know what I mean? And that's the issue if of getting too complacent in like a melt up kind of market, because some of the rallies we've seen this year and last year have been total straight just melt ups. And when you get like I don't want to say bubble move, but like a parabolic move like this in the market, there's a lot of emotions come into play. And I think people just fear missing that move again. You know
So
what I mean?
here, yeah. That's really interesting because man, that has been going through my head a whole lot. So two things. First, how long has Mark Minervini been trading?
Oh God, I don't know.
40 plus years. How many market drawdowns and bull markets, how many times has the market gone below a declining 9 and 20 and 50-day moving average since in his 40 years, right? Unknowable amount of times.
Yeah.
So right, he's experienced that. So for as many of these right here, and I'm about to point to two very similar days. This is May 3rd of just a few months ago, right? That's May 3rd, big gap up day. Now I'm going to draw right here yesterday is there's really not that much of a difference between these two candles. Sure, we can go back and dissect, okay, well, we put in a couple higher lows, maybe, some accumulative signs and, this and that, and, the gap down getting bought up. But there's not really much difference between these two candles. You can argue that moving averages were above the 9 and 20, but they're still, jumbled on top of each other. The 9 EMA is sloping up, so there's that. But maybe it wasn't sloping up at the time. Maybe it's just sloping up because of the days that followed. So where can we, implement a system to differentiate between this day, the 3rd, and this day, the 31st, and the days that follow? So, is there anything wrong with buying right here versus buying right here? And if you guys want, for the people that are going to make it and be successful, you're going to go back and look at what individual stocks were doing at this time and this time, right? Compared to, now the leading sectors, the relative strength sectors, etc., what they're doing. But is there really much of a difference between buying this and buying that? No. In fact, even if you put a stop below the daily 9 EMA, you're still probably risking the same exact amount at these times. So with that being said, here we are here. What's the difference between buying it here and potentially buying it here after we've built out for a few days, accumulated, gotten the 9 and 20 to rise up underneath price, get trend structure in place, and put in a higher low, an area to trade off? Very little, right? In fact, right here, there was a major sign that occurred just today. Which, Brocco, again, that was that is one that I'll remember listening to that pre-market, and seeing you trade this. I know you sold early, but I think everyone who took a single trade today sold early. Which, I mean, whatever, 100% trade is not. Anyways, what's the difference? We popped up here and then we, completely rejected back in. You could have literally gone short. There's a 30-minute candle and anywhere in here just saying, okay, what is the market structure? What just occurred? We just tried to pop back into this gap, into this 475 spot. We had multiple pieces of data. They just grabbed liquidity up here. We haven't had time to accumulate anything down here. We haven't put in any higher low. In fact, the opposite, we just put in a lower low the day prior. 2 days prior. And then we're sweeping through this spot, rejecting and coming right back down. I know this was a, fantastic example of you getting short, all the way up here at the top. But, what's wrong with getting short, at the red to green? What's wrong with getting short when the 15 or the 9 and 20 get below these moving averages down here on the 5-minute time frame? What's wrong with taking, a trend line break right there? If you are going to short the market. Or on the contrary, say you did, take a few feeler longs on, XBI or ARC or, whatever. When this happens right at the open and you start failing back down and the market's going red, there's nothing left to do but get out of everything. Even
get out of the market.
Even winning positions. At that moment, I was in the car. I pulled over on Highway 15 and just started selling stuff. Just selling, piece of share. At least I started out just selling partials in my father's account, and then because I bought a few things over there, and then I went to my trading account, started selling a couple hundred shares of some things, and I'm like, no, I'm selling like all of these positions right now, stopping out, taking profits on positions that I've held.
Yeah, it's okay to take feelers, but you got to keep a tight leash on them because the market has not proved itself yet. And go on the daily chart. Maybe it's as simple as this: that example that you marked out back in May, the 9 is above the 20.
Yeah,
and that was not the case this time around.
Yeah. Yeah. I mean, look at the wide gap of the discrepancy between these.
It was big, dude. It was big this morning coming into today.
Yeah.
And coming into today, the 20 EMA was like almost $7 above the 9 EMA, which signals pretty strong momentum to the downside.
Yeah. The more I look at this, the more of such a strong short setup that was, Brocco. It's just incredibly impressive.
Yeah.
not to, blow smoke up your ass, but
It's difficult too though, because it's a lot different. Like a lot of the shorts, the best short setups are like the failed moves, right? Especially in in a volatile downtrend like this. It was the same case when I tried on that SPY trade that I took with, what was it, Jolts on Monday or Tuesday. On Tuesday out of the double inside days, when I was looking for a sweep of the high and come back through. It was the same idea, right? I mean, think about how many people. I mean, we just had our best day of the year on QQQ. Think about how many people were just FOMOing all night, waiting for today to buy stuff. You know what I mean? And then we get that big pump in the morning into a massive resistance. What's the most likely scenario? You know what I mean? That was kind of what was just going through my head. Just you got to think about like what are majority of participants thinking. A lot of my trades, there's like a lot of psychology behind it. You know what I mean?
mm-hmm.
Not purely just technical. There's a lot that goes into it. But whereas an uptrend, the moves are a lot smoother. Maybe you're not seeing a ton of fake outs. It's a very predictable market. It's smooth, right? It's low volatility. But when you get a market like this, there's going to be a lot more fake outs like that, you know?
Yeah, Jesus. For those of you guys that have been, around for a while, is right here. We look at SPY and talk about SPY or the Qs maybe twice a day, right?
Yeah, seriously.
There'll be some bullshit scalps here and there, but that's not our like priority focus for the day. Our priority focus is, trading the single stock setups, buying, shares or options contracts 2, 3, 4, 6 months out, and getting 30, 40, 50%, selling a third, trying to get another 80%, selling another third, and then riding that for as long as possible, until it becomes like an Eli Lilly type of trade, or an ANET type of trade, right? And what is happening intraday on the indexes does not matter during those times. But when it does matter, it really fucking matters.
Yeah.
Because you can't disobey that. You can't underestimate it. Because the market is extremely good at washing you out and churning shorts, churning longs. In fact, I want to, I send that message of there's nothing to do here. Don't be a hero at open on the 23rd. Send another message out, which I'm going to take a second to find here. I'll wait for things to settle. Do not be a hero. Then I went and took a couple of trades. I do want to find this one. Dow Jones, healthcare staples, utility, as well as biotech show great relative strength. We can look for longs here. Semis and tech look weak. Look for shorts there. Okay. Okay, here. We're at, I'm going to add in a few words, but we're at a spot where the market will churn buyers and sellers. Ideal scenario is seeing volatile up and down moves that ultimately create a higher low, leading to a remount of moving averages and wedge pop on the daily. Wait for volatility to contract, and that will signal an imminent pop through the MAs. Main point of this was market will churn buyers and sellers here, and that's what's occurring right now. Whether this downtrend continues, which my guesstimation is that most stocks and most likely the index is going to come into the 200-day moving average on the daily. I don't have it here on this chart. I'll just pull up this one right here where the 200-day moving average is. It's down at about 430 right now, inclining. I expect this, it will keep rising up until we reach this massive volume shelf from basically February to May, and likely will settle out, from there, maybe in the, mid to low 440s. That's what I kind of anticipate happening. Does that happen? I have no idea, but if we start seeing some volatility contract here over the course of 4 or 5 days, and then get the 50 SMA curling down and flattening out, get the 9 start to curl up underneath price, see some lower wicks, see some tight ranges develop on the market, then we'll know whether we're at the 200-day or not.
I think you had a really good point there that you didn't go into in your message that you just read, but you talked about volatility contracting, and Oliver Kell talks about that as a major key when looking for a wedge pop. Volatility contraction. Just look at how loose the action has been the last 6 days, right? You look at how much more volatile these QQQs have been. I mean, we just had our 2 worst days of the year in 5 days coming into this week. And then the market comes and has its best day of the year. That might feel bullish in the moment yesterday, but that much volatility is not a healthy sign. That's an unhealthy sign, right? Volatility is usually not a good thing. You'd want to see this get a lot tighter. I mean, look at when we got it back above the 50-day in May. Look at how much the volatility just immediately died down. We just had like 6 days of like not even like $3 a range. You know what I mean?
I'll just go through. Well, in fact, I'll just go through the SMH percentages. Okay, the May 3rd day, was up 2.7%. The follow through day, 2.27%. The next day, 0.87%. The following day, 0.3%. The following day, 0.64%. 1.5%, 0.02%, followed by 1.7%. And then it was back on trend, and then ultimately led to a 25% rally from the first tap of the 9 EMA after that. 25% rally. Right now, I'm just going to read off a few days of SMH percentage up and down swings. Down 5.5%, down 2%, down up 1.6%, down 0.7%, down almost 4%, up 7.7%, down 6.5%.
That's not good.
That's on the SMH.
Yeah.
So, and there's one more. Sorry, Rocco, to interrupt. Do you want to go further into that? Seeing that volatility contract, and how we approach that at all, or no? Or I can go on to the next point.
No, I just think it's a really key thing to look for, right? These big swings are not generally, a healthy sign. That was, one of the major reasons that I wasn't really buying it into today. I mean, I was mostly leaning short on most things coming into today in the pre-market stream. And it was because of that. We hadn't tightened up yet. We hadn't made it any higher lows. We didn't really build a clean base. It was still, really volatile. And you need volatility to die down first. And one thing I wanted to, I was watching a Mark Minervini interview about an hour ago on YouTube, and he had a quote that was really like cliche, but I thought it was like really good in a way too. And I'm sure you guys have heard this a million times, but it stays true forever. He said, it's not hard to make money when the markets are going up. The hard part is keeping it when the markets go down. And I just thought that was perfect. Super cliche, I know, but
cliches are so true. You guys have heard me say a bunch of times that I love these cliche lines, and it never really realized it. Until a few years ago, I'd be like, yeah. I'd always hear, right, manage your risk, this and that, or even like life cliches of whatever, with kids, or with your spouse, or with friends, whatever. Some of those just cliches that you can think of any cliche in your head, just very direct and common phrases that you just kind of brush over, like yeah, manage your risk, it's important, keep your money, you can make money, but it's about keeping it. But it is so true. That is a 40+ year veteran who just spent 3 hours on Trader Lion going through his strategy, barely talking about sectors, stocks, wins, losses, talking about when they're going through some of their trades, how they manage their risk.
I know. I don't think he bragged about making money on a trade once. If anything, he bragged about managing his risk when setups started to fail.
Yeah. And yeah, so those cliches, I mean, write them down and ingrain them, and not only that, remember them, but take it a step further, right? Take phrases and kind of see how they can result in action. Um, so okay, it's not about how much money you make during an uptrending market, but how much money you keep when the environment becomes tricky. Okay, how do I put that into practice? What are maybe some rules I can implement to make sure that I'm living up to that, at least a little bit better than the last one? And that's where some of these, disciplines of trading above and below moving averages comes into play, or trading tight patterns versus chasing high flyers, right? Some of those bad habits. In fact, you go through any Discord, seller, them, retweeting member gains of NVIDIA or SMCI. These were stocks that were 12% above the 90 EMA, right? We're talking 50% above the 50-day moving average, up 5% on the day, and people continuing to pile into 10% out of the money options that expire in 2-3 days, and they're making money fucking hand over fist. I'll guarantee if you go back and find someone who from some of these groups, that those members are washed right now after a 5% drawdown on the S&P and after 10% drawdown on the QQQ. They are washed. Or Tesla even, right? There, comments about, why aren't we sticking with this and, continuing to, take, aggressive day trades up here on, Friday the 5th and the 6th. These are going red to green up here. Well, because, these trades are entered down here, my risk is completely out of this trade, selling 100 shares, maybe could have been better at buying more into the initial strength, on the days to follow, and just kind of keeping the risk the same, moving stop up to previous day's low or low of day while adding some position, right, keeping into this. But immediately, stop is here. Once we go sideways for a few days and go break out through the 200-day moving average, okay, my stop is at this low day, because if we pop up through the 200-day and come back all the way down, that's not a trade that I'm going to want to be, sitting through. I'll wait for this to go sideways, build out another base, and then re-enter this back up here after stopping out down here, and locking in, right, some decent money, but completely stress-free, completely risk-free. Now, after this move down on Tesla, or even right NVIDIA, right, some of these high flyer names that were buying call option $1,000 call options, $1,400 calls on the 28th of May right here. Sure, they were they were rewarded, but all that money is given back now. 100% guarantee it. Maybe one out of 1,000 people who traded that way still are at highs in their account or above where they were that day on P&O for NVIDIA specifically.
Yeah.
And that's the interesting thing about habits and systems, is it is hard both ways to stick to it, because it is so strict on the way up, and it is strict on the way down. There is a small window that it is allowed to be implemented in. And that's how you keep money, is by knowing what that small window is for you and being able to look through it when the time is right. What's your small window, Bracco?
Small window. Well, one thing I did want to say was, um, we can sit up here and preach and teach all we want, but that can only do so much. The reason I'm green throughout this market correction is because of one thing and one thing only, because I've gotten my ass handed to me on multiple corrections before this. And I think for a lot of newer traders who got killed in this correction, you just got to take it as a learning experience. You'll hear another cliche that screen time is the best teacher, and getting in the market and getting active and taking trades. And it's very true. You really just got to learn from your mistakes. And you guys heard me talking about, I did like a workshop a little bit ago with Greg after we, started seeing some red flags. And I talked about how the first thing I did was spent all Saturday night kind of reviewing my performance and how I handled previous corrections and stuff like that. And if we did enter an environment like that, how can I avoid as big of a drawdown as I've taken before? So a lot of it is having that experience and going through these corrections and these cycles to be able to kind of be prepared for the next one. It's really hard to just hear something from someone and put it into action. You kind of have to go through it yourself, I think. I think that's a big part of it too.
Yeah, not taking trades is just like, taking some, or experience is the best teacher, right? And that's why, like, you can go back and study, and Brocco, you and I have spent a lot of time on Zoom going through, charting out the VIX, or going through periods like this in the market, and looking for what signs of them turning from this into this, right? Or small periods of 2-3 months that turn into something like 2018 that lasted almost an entire year. And what are the signs there? And it's so much different looking at them on the chart in the past versus experiencing them in real time. But it is a good combination of that, is of scanning through thousands of stocks a day, every evening, and seeing the way that they move from day to day, and then during the day seeing the way that they're behaving during the day, compared to other stocks that you're looking at, and then as well as some positions that you're taking, watching them move up and down so much or so little. Yeah, I'm going to be honest, Brock, and I even talked to Bracco, is are we I was like, are we doing some sort of disservice trying to find even opportunities like even like a Pepsi, or like Next Era Energy stocks, that more defensive stocks, and trying to long those? Are we doing some sort of disservice by saying, hey, Pepsi's going nuts here, let's look at this, or pulling back to the 9 EMA, holding the VWAP throughout the day? Are we doing disservice trying to saying, looking for opportunities on a day-to-day basis, when we know that the best thing to do might be to be getting short the relative weakness, or sitting out and going to Italy, like real simple area, right?
Yeah. Yeah, actually, I was doing research on Paul Tudor Jones, and he actually in 1994 trained a team of traders to trade sort of the way he did. And he sent out like a little memo to all of them through email, and I found a picture of it, of like the real paper form that he sent to all those traders, and it was basically a complete outline of his strategy. and like what to expect. And I'll read it. This is so similar to what you tell us to do when the market corrects. It says, to all traders, from Paul Tudor Jones, December 20th, 1994. Topic: risk control. When a trader draws down for a peak, a series of proactive, predetermined measures will be implemented to assist the trader in regaining a profitable form. A total self-evaluation process will be required to identify if the drawdown is the result of inappropriate trading behaviors or the result of the natural ebb and flow of the market prices and profits and losses. Additionally, the drawdowns will be accompanied by reduction in trading size, reduction in number of trades, trading for liquidation only, and vacations. There you go.
Size, frequency,
Duration.
yeah, duration. Size, frequency, and duration of your trades. Yeah. To where he's essentially saying, all right, you guys are employed traders of this company, sorry, of this firm, and you know, you have a system that you're supposed to be implementing. Is your drawdown due to, right, natural ebbs and flows of the market, or are you on tilt? Are you, you know, going through you know, mentally making poor decisions that are aside from our proven system? And if they are, if you are, you know, weaving out of that, you know, discipline, then the best way to work your way through that is by changing your sizing, changing your frequency, and changing your duration. In fact, I haven't said that throughout this move, but every other, you know, pullback in the market.
One of the best things you ever said for me for my trading. I've completely implemented that in my tradings in the last 2 weeks. 100%. I mean, the number of trades have been drastically down. I'm not holding trades nearly as long. I'm keeping a tight leash on everything. I try to bounce.
Kind of sizing up on them though, which is fine. You know, that's actually recommended if you're going to be trading to the short side and you're doing it really well, which you have been. Then size up on them, because you get the same result from sizing up. Like, you're not risking like an extra, you know, maybe, you know, you're risking a couple extra, you know, $100 or $500 on the trade, but you're sizing up on them because the market is giving 100-point ranges. Or on the flip side, you don't have to size up because the market's giving 100-point ranges. You know, it's the same thing as taking, you know, 15 lots of positions and getting a, you know, 20% move, or sorry, 20-point move, then taking 3 lots and getting a 100-point move. It's still the same result. So you can use that sizing to your advantage. Sorry.
Yeah, exactly. Yeah. I mean, I'll lower the number of trades I take and the trade duration if we enter a correction like this, because you know, I know I need to, but you know, I won't size down my positions until I enter a drawdown, right? There's no reason to. If I'm feeling really good and the market's just giving me even more range and better setups, in my opinion, you know, why would I not use that to my advantage? But I mean, you saw I sold QQQ today for 80% profits. I had a pretty decent position size. I think I made like $2,000 on the trade. I was a little bit upset about selling it early. Like, yeah, it sucked, but you know, like, you know, looking back on it, like, I was totally fucking pumped. I mean, I had the perfect read on the market. I got the perfect entry. I managed the trade pretty much as perfect, I think, as I could have. And one thing you got to get used to in a market correction, when ATRs expand and you get volatile moves like this, you're always going to sell early, right? The chances of you capturing the entire move are so low. And if you try to hold for that entire move, you're going to get a lot of it back. So, you know, I mean, if you zoom out on that chart today, I sold pretty damn early. And, you know, I was fine because, you know, I mean, I made my money for the day. You know, I did what I wanted to do. I took the trade I wanted to take. It's going to go further, you know, that's okay. But I've already got into the mindset of keeping a tight leash and, you know, taking what I can get in this market. You know what I mean? Because to even just stay break even in a correction is massive. And to be profitable in a correction, that's a whole other level. So I'm just, you know, really just taking what I can get right now. You know what I mean? Does that make sense?
100%. In fact, I was gonna wait to see if you would bring this up. There's another thing too, and you know, I don't mean to dissect, you know, some of your trades, but I'm gonna dissect some of your trades. So there was this move here on the 16th, remember this?
Oh, do I remember it?
This one here, right here,
Uh-huh.
and then this one here. So do you there's
No,
a,
you can go.
okay, so there's a few things that we talk about with a sequence of a move, or right, getting in tune with the market environment is or at least a trade system, which Brock, obviously developed, and the most skilled person I've ever seen trade, besides Canal Desai. But there's there's going to be trades that you recognize and miss, and then there's going to be trades that you recognize and then mismanage. Then there's going to be trades that you recognize, enter, execute, and sell early. And then there's going to be trades that you recognize, enter, and fucking ride for the full move and capture so much money that you're going to be just like baffled at.
Yeah.
Right? Some of those numbers that we throw around in the chat, like, oh, this position size would have been worth, $50,000, or whatever. I don't mean to mess with your psyche if this setup happens again, and then it, goes, 80%, and then all of a sudden spikes up and it's back to break even. You're looking for something like this, but you're right, like this, like, in year, 3 or 4, that those ebbs and flows are going to happen, right? I do that all the time. I joke about, I make a living selling early, but that frustrates me, getting out of trades that are still working, but I'm taking a third off and a third off, and it's continuing to work where I should really be adding to that position, maybe. Or I should be just letting it ride and moving my stop lower. Some of the things that we teach and talk about. But every now and then, right, there's that one of those good trades that comes by where I hold to completion, or ride just a little bit longer, and that extra little bit longer ekes out an extra 2-3 grand, or that one runner makes up for the first third or fourth that I sold into the beginning part of the move.
Yeah.
So anyways, I just thought that sequence, I was actually hoping you'd bring that up tonight. That sequence of just of all of these moves, and just the perfect progress of the trade management was just
It's funny that they got better each time, because the first one on 716, your first arrow, was just brutal management. I mean, I was almost embarrassed by the trade. And then, that happened. And then the next one, I had a little bit better management. I got a better entry, and the entry was a lot better, and I mismanaged it again. And then you got the Monday or the Tuesday on Jolts. Caught 90% of the move. You told me, remember when you messaged me, you said force them to take that from your hands. Caught 90% of the move. And then today, just the best read, the best entry I've had in a while. And I missed a lot of the move today. I maybe caught what did I catch? Like maybe like less than 1/3 of that move, maybe a little bit more. But all that I cared about was that I traded the right way. Really, that's it.
Yeah.
A big thing for my strategy and my confidence is knowing that my reads are good and I'm reading the market well. And after missing those first two like wedge drop trades in the EMA crossback that I was positioned in, it sucked. Like the FOMO was so hard to deal with, and knowing that I was like right and mismanaging the trade, but knowing that my reads were like in the right spots and I read the market like perfectly is what helped keep my confidence there to continue to, try to take these trades. And eventually, they worked, but yeah, throughout those 4 trades, my execution, my management, my entries got better and better each time, for sure.
Yeah.
For sure.
So what happens then, when we get because we've been talking about this, how this is very possibly just a base and break, You can screenshot that DM that you sent me. Was I actually thought they were gonna fake wedge pop this and trap more, to be quite honest. I thought they were gonna go up a little bit further and then maybe go sideways and really suck some people in versus just, straight, gotcha, like quick rug.
I mean, that's
So
exact. I didn't realize that's the exact candle that I drew out on that chart I sent you.
yeah, right there. This was, yeah, look at that. So this was yesterday morning.
Yeah.
Yeah.
So we could be at that stage for sure. Who knows?
Yeah. Um, okay. Hey, does anybody, I know we've been kind of
Yeah,
going
I'd love
back
some
and
questions because I know we just covered a lot.
I have one comment. There's not even a fire. How is this a fireside chat? I hate that
I don't know why I
going
thought
on
of
in the
it.
world. Everyone calls every conversation a fireside chat. There's no fucking fire. That really pisses me off. There we go, Yeti. Appreciate that. Um, yeah. Anybody have any questions, comments? I know a lot of people talking in the chat. I see Camden typing. By the way, Camden, I listened to your voice message this morning in the car. You had a great read on that. I know you've been really busy with work, but I've been thinking about I've been thinking about you because this is man, this is your kind of environment, man. This one, please. Okay, perfect. Here. Um, I have a personal problem in May when the market was coming out of a correction. I tend to think like, oh, the market's close to hitting potential resistance at all-time highs. There's not much room from here. Maybe the market makes a double top type pattern, so the risk of reward is not worth. Okay, this is a great question. Only in hindsight, we see that SPY actually ended up going above all-time highs, retracing a little bit, then moving a lot higher. Okay, so that's where the mindset of okay, so this is May right here and then pulling back in into here. Okay, this is where, so two things. One, mechanically, where are the 9 EMA and 20 EMA in relate, or the 20 SMA or whatever the hell, right, in relation to price, slope, and stacking, right? Are they above each other? Are they sloping higher? And is right, is price holding above them? So that's first thing, number one. Because in that case, then right, there's still a right green light. You can still go through the stoplight and trade. Second is there's no answer, meaning that don't try to discover that. Don't try to time the top, meaning that you're always going to have drawdowns from the highs. In fact, Bracco, you and I were just talking about this on the phone. I said the first 3 days of this, I lost a lot of money. But since then, since Monday the 22nd, I've made a little bit, not much, but I've been, essentially flat trading, up like $900, which, whatever. Since the 22nd. So I'm completely fine with that drawdown from the high. In fact, I wish it was a little bit less. I wish it were. And in fact, I wish I've made a little bit more money because I should have. There've been, probably three trades that I wish I wouldn't have taken. So, these 3 drawdown days are going to happen every single time, and that's 100% fine. But is how we're going to react right here where blow up occurs. And so accepting there is going to always be a natural drawdown from highs is key. And finding resistance or finding the top is there's no point in that, especially if the system is, or there's still a green light in the market, which for a second here on Thursday the 30th, it was like, oh, certainly protection a little bit, and then all of a sudden Friday, towards the end of the day Friday, I think I alerted like 4 trades in my channel on this Friday the 31st, or maybe just like 3 trades, but because we lower wick and we just started ripping, right? And then throughout the early part of June, there was a lot of trading activity occurring. from myself and from Manrev, Alex Jones, Bracco, right? There's a lot of swing trades being initiated, a lot of breakouts being taken. Whereas in right here, after this day, it was okay, a little defensive, a little drawdown, stopping out of positions, boom, re-entering, right? That was a little heat check trade or what? You can take those now and then. I love taking those. Um,
Yeah, I mean, I don't got much else to say, honestly.
okay. Yeah, McDonald's. Man, fuck that thing.
Hmm.
This was a solid setup, man. Broke down, gap down, and then just kind of ripped right back through.
I was taking, if I'm gonna finish with this, I was taking some notes on some things to talk about tonight.
Mhm.
I was in my office, my girlfriend, and I asked her if she had one thing that I should tell the traders, uh, like a tip for when we're in a correction, the market's getting nasty. And she said, don't get a big ego and don't be a dumbass. So I want to throw that out at the end.
Yeah.
Well said.
Don't honestly though, don't think you're smarter than you are. You see, I make fun of people all the time for thinking they're smarter than they are. And which don't have an ego and don't do anything stupid. Don't be a hero. Right? You're neither. You're neither smart nor a hero.
That was a quote I posted the other day in the quotes channel. That's awesome channel, by the way. I'm so happy we added that. But it was
Yeah.
Paul Tudor Jones. Don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good at this. The second that you do, you are dead.
With that, sharpen your trading skills, August 1st, season whatever, episode whatever, fireside chat with Brocco and Patrick is concluded. See you in the morning.